Restoring American monetary sovereignty. What if the United States could fund its growth without increasing debt, without raising taxes, and without depending on global financial markets? What if we could take back control of our money system? Because right now, we don't fully control it, and that comes at a cost. Today, most of the money in our economy is not created by the government. It's created by banks. Every time a loan is issued, new money is created. That means our money supply is tied directly to debt. And that means we are constantly paying interest on the very money we use to run the economy. Think about that. In order for money to exist, debt has to exist. If lending slows down, the money supply slows down. If lending expands, the money supply expands. That creates a built-in cycle of expansion and contraction. This is why we see boom and bust cycles. It's not random, it's structural. The system itself creates instability. Over time, this leads to rising national debt, recurring financial crises, and reduced control over our economic future. We've built an economy that depends on borrowing just to function, and that creates long-term pressure that never goes away. But that's not how the system was originally designed. The United States Constitution is clear. Congress has the power to create money and regulate its value. That authority was meant to be held by the people's representatives, transparent, accountable, direct. What we're talking about is restoring that original design, not replacing the system with something untested, but bringing it back to its foundation. The solution is straightforward. A two-step plan, not theoretical, not radical, practical, structured, and based on real American history. Step 1 restores control. Step 2 restores stability. Together, they rebuild the foundation of the system. Step 1. The U.S. Treasury issues currency directly. These are called United States notes. They are debt-free, interest-free, and created by the government, not borrowed from the system. Instead of issuing debt every time money is needed, the government can issue money directly into the economy. This changes the structure immediately. It reduces the need to borrow. It lowers long-term interest costs, and it puts control of the money supply back where it belongs. This is not a new idea. During the Civil War, Abraham Lincoln issued United States notes to fund national priorities. The country functioned. The economy moved forward, and it proved that sovereign money can work. Step 1 matters because it is visible. It produces results people can see. Less borrowing, more flexibility, greater control. And most importantly, it builds confidence. It shows that the system can operate without relying entirely on debt. Once that confidence is established, we move to Step 2. Step 2, we transition to a system where banks no longer create money. This is called 100% reserve banking. Banks still lend, but they lend existing money, not newly created money. This is a major shift, because it removes the ability to expand the money supply through credit creation. No more creating money out of thin air. No more artificial expansion of credit. No more hidden instability built into the system. This stabilizes the financial system at its core. It reduces systemic risk. It limits the formation of bubbles. And it helps prevent the cycles of expansion and collapse that we've seen repeatedly. The economy becomes grounded in real activity. Production, investment, innovation, growth. Not just credit expansion. Even mainstream economists have recognized this issue. Milton Friedman once said that if you don't eliminate fractional reserve lending, you haven't solved the problem. Because real reform is not about adjusting the system, it's about fixing the structure. This approach gives the United States a powerful advantage. It allows the country to fund infrastructure, support manufacturing, and invest in long-term growth without adding to the national debt. It creates flexibility without instability, control without dependence, growth without built-in debt pressure. This is about economic independence. It's about long-term strength, and it's about restoring control over one of the most important systems in the country. This is not just monetary reform. It is a shift in how we think about money and who controls it. It restores constitutional authority. It strengthens the economic foundation, and it puts the United States back in control of its financial future. American money, American control, economic independence.